Hello, happy Thursday. Hope you are doing well. We are going to talk about inflation, income, and spending at still very high numbers. A quick update on earnings this week and kind of where we're at in the earnings season. And then a great question of the week about Europe's economy and their recessionary concerns. My name is Brandon Steele, financial advisor with Mainsail Financial Group. And every Thursday at 3, we bring to you market updates and kind of try and bring to you some of the more important items and hopefully weed out a bit of the noise along the way. So starting out, we'll kind of start with where we left off last week. On Friday last week, we had a lot of data come out. We had PCE price indexes all higher than expected. So the story of inflation is still here, and as a kind of a little bit of a tip of the cards, next week we'll get the CPI data as well. So that will be very important to watch. But again, PCE price index is still all higher than expected, which I think has been the theme for the past 6 months or so, and likely will continue. Income and spending were also higher than expected. So even with prices, up, income has been growing along with that, maybe not proportionately, but it has been growing. And really spending, again, we talk about the consumer all the time. Spending really hasn't shown many signs of slowing. So spending was also higher than the expectations and an increase again from last month as well. As a quick kind of scoreboard on the earnings side of things, here we are a little over halfway through the earnings. A little bit over half of the companies have reported so far, and so we can kind of get a little more clear picture on what's going on and what where we're at, but still a lot to unpack in the coming weeks too. Nonetheless, earnings has actually been pretty good. The blended growth revenue growth rate has been about 6% so far, somewhere in that range right now. But the expectations going into this earnings season were closer to 4%. So we had a lot of low expectations coming into this. A lot of companies are still beating and still showing that they are producing profits. Maybe not to the extent of where we were before, but certainly higher than the expectations coming into this earnings season, which, as you probably have noticed, has kind of catapulted a little bit of a cycle here on the upside in the markets, which is very nice to see after a tough year. In fact, I think July was the best month in the stock market since COVID kind of rally started there in 2020. But what I want to really point out is that although this is great news, we have talked about this multiple times. We kind of expected earnings to actually be pretty good going into this. We are concerned and had been about expectations moving forward. So although companies are still showing that these earnings are better than expected, a lot of companies have cut their forecast, cut their guidance for the year moving forward. And, it's not necessarily anything to be too concerned about yet, but I think there's this delayed fuse on a lot of this stuff. So as inflation, as interest rates, as all these things carry through, it doesn't just take place overnight. These things take a while to work through the system and the economy, as we know from 2020, right? When we turn off that light switch and turn it back on, it doesn't just flip back on. It takes some time to work through. Same applies to these macro environment items. And so that's been really important to watch. And hopefully, as we continue through earnings season, maybe we'll hear some other companies going the other direction. But right now, most of the guidance that has been changed has been towards the downside. So we'll keep an eye on that moving forward. This week on Tuesday, we also had job openings come out at 10.7 million. So still, a huge number, but it does show that the labor market is still strong. However, today on Thursday, we had initial jobless claims come out at 260,000, which was higher than last week. So it shows that the labor market is still strong, but we are seeing on a more weekly basis, a more time sensitive basis, I guess, that it's possible that some of that jobs market strength is eroding a little bit. It's too early to say that for sure, but certainly could be headed that way. On Wednesday, we had the ISM number come out bigger than expected. Markets just loved it. You probably saw the markets rallied quite a bit on Wednesday. Again, just great to see that after what we've been dealing with here in 2022. So good little rally there. Coming up, though, we'll get a better glimpse into the jobs market. So tomorrow on Friday, we have non-farms payroll coming out. So we're going to get a real tune of the labor market and kind of what's been happening over this past month. So definitely stay tuned next Thursday. We'll kind of share with you what we're watching there. Plus, we get all the inflation data on Wednesday. So next Thursday is going to be a really good one to kind of catch up on as we talk about the labor market and we talk about inflation again. All right, with all that, we'll kind of jump into the question of the week, which is really good. We spend so much time talking about the US economy and not a whole lot about Europe. So the question of the week this week is about Europe's economy, what's going on over there, and kind of their recessionary situation, concerns, insert your word there. But basically, where is Europe's economy at in all this? And I think this is really relevant because we've been talking about this a lot with our clients over the past 3-4 years or so. We've really reduced our exposure to European and international equities. You know, don't get me wrong, we're not throwing the baby out with the bathwater, but certainly a lot less than a lot of the indexes or a lot of the funds might have. You know, we've seen a lot of exposure, 30-40% in Europe, and we've just really never believed that was the best solution. And I think what we've seen this year, you know, kind of carries some weight into that as well. Europe is down just as much, you know, developed markets are down just as much, if not more, than the US market this year. And really, there's a lot of concerns now about their recession coming into play towards, you know, maybe the end of the year or so as well. And so I think the ECB also just raised rates, I think 0.5%, 50 basis points. So it's, you know, it's funny to, you know, we spend so much time on the Fed and what's going on here in the US, but there is also obviously a lot more out there in terms of the broader world economy. And Europe is a big player in that. And so I think it's important to maybe catch up on that. They have been increasing rates a lot slower than the Fed. And I think a big part of that is I guess, tied to this whole recession thing. I think that they are very concerned. They have had huge concerns about energy prices, especially going back to like the start of the Russia-Ukraine war. Well, actually even prior to that. So even into late last year. But especially with that has been a big concern. And that is the huge concern moving into the fall and winter is there is a lot of concern about Europe's number one, energy prices and how high those might go moving into the fall. But number two, even their ability to get oil. So we are still, you know, a little concerned with Europe. I would be very cautious looking over there. It's not to say there aren't opportunities, but generally speaking, you know, I think if you look at the two, we're both in a probably tough financial cycle. But, you know, when you look at the two side by side, generally speaking, the U.S. might be a better place for a bulk instead of, you know, it doesn't mean you can't have some in Europe, but I would be a little cautious in how you're handling that piece of it. So I hope that helps. It was a really good question of the week, very timely with the ECB rate decision. And I think even the ECB was sharing a lot of concerns about their economy moving forward. So I don't think this is going to be a quick recovery for Europe. I think, you know, this might be a longer period for them even than it is for us here in the US. So certainly something to pay attention to there, and a great question. Anyways, with that, we'll see you next Thursday at 3. Again, we've got a lot with jobs and inflation. So we really look forward to seeing you next week. In the meantime, have a great weekend. It is Seafair weekend here in Seattle. I'm actually going out on an industry event tomorrow to kind of soak up some of the festivities. So have a great Seafair weekend. And if you're not going, just enjoy the sun in the first place. And we'll see you next Thursday at 3.